As Markets Insider reported, Nvidia is the king of AI and it's recently become the king of the stock market. But is Nvidia still a good investment today after rising so much? Watch this video and find out. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Today we're going to take a look at Nvidia, which has been obviously probably the hottest stock in the stock market here in recent months and weeks. And is obviously, as I said in the intro here, the king of AI. The question is, after such a rise, is Nvidia still worthwhile investing money in? And what I'm going to do is I'm going to utilize the FastGraphs Fundamentals Analyzer software tool to help answer that question. In other words, is Nvidia today, at today's valuation, still a worthy investment for your consideration? So let's go into FastGraphs and analyze and use the analytical power of the tool to determine and learn about Nvidia. First of all, let's start by learning from the past. Here I've got a max chart that goes all the way back to the beginning of 2003 through yesterday's closing stock price. And as you can see, we had this strong surge in earnings starting in about 2017 and expected to continue through 2026. But if I look back here, it's really hard to see the data. But thanks to the analytical flexibility of FastGraphs, I can use my scroll bar here and I can go back, let's say, to 2014, and I can look, I actually go to 2015, and I can look at Nvidia from a standpoint of what it looked like in those early years. Now, one thing I want to point out is the stock grew earnings at 11.35%, and that's from the fiscal year, which starts in January, the end of January 2003, through the end of January 2015. This company grew at 11.35%. Now, that indicated a 15 PE ratio, which is the orange line on this graph. All right, now earnings determine market price. And what you see on this graph is that the stock price kept reverting to the mean. It kept coming into this, 15-ish PE ratio. Here it was 20. Here it got right down to, right at 15.3 times earnings. And then coming into the Great Recession of 2008, after the stock had become, had strung together three really exceptional years of earnings. 4 years, you could call it 33%, 202% growth, 74% growth, and then 36% growth. And the stock got really highly valued, and it was trading here at a PE of 28.9 with only an 11% growth rate. However, as the recession hit, the stock's earnings went from 34 cents down to 6 cents. That was an 82% drop in earnings. And of course, that instigated this, huge collapse in stock price, which was almost 79% drop in price. Part of it because the company was overvalued, and part of it because it reverting to the mean. But reverting to the mean in this case meant reverting to a mean of dropping earnings. All right. Now, let's take the scroll bar. Let's move things a little forward. And what I want you to focus on as I do this is watch this right here, the adjusted operating earnings growth rate. During this period of time, in the early years, it was 11.3%. But as I move this forward about 3 or 4 years, all of a sudden growth now has run up to 18.9%. And now we're using the P equals growth rate formula that Peter Lynch made famous. Any time a company grows above 15%, we use the P equals growth rate. So here we're putting a PE of 18.97 on the orange line as a valuation reference. And you could see that valuation reference work very well. When it gets a little above that, it comes back. When it gets above it, it comes back. And even when it gets below it, it kind of tended to move back. It obviously tracks these earnings results very well. But then we had a very strong surge of earnings. From 2017, we had a 138% increase from 27 cents to 64 cents. Then we had a 79% increase following that from 64 cents to $1.15. And so this surge of earnings also caused this surge in stock price, and the PE got up here now up to over 50, 53.11. Now, when a stock gets way overvalued like that, although it was partially justified by this strong growth, in other words, I can understand why the investors got excited during this period, but let's move this a couple of years forward, just pre-COVID, and what we see is that when the stock price hit that very high valuation, we ended up having a down year of earnings, a 13% down year. We had the 138, the 79, followed by 44, And then we start seeing a weakness in earnings. The earnings fell 13% from 166 to 145, and the stock took a big hit. But however, if I keep going forward again, that temporary drop in earnings, which, by the way, created this, opportunity to buy the stock undervalued, because now I want you to note the growth rate during this time frame is 36.22%. We don't use P equals growth rate once it gets above 30. We cap the PE at 30 as a valuation reference, and you can see that worked very well in this case. The orange line is a PE ratio of 30, and the stock, pretty well tracked within a reasonable ratio, upper plus or minus of that. But then we do see this high valuation, which was obviously instigated by these very high growth rates. And then once the stock weakened, we saw this precipitous drop in price. And as the stock was weak, it stayed below a 30 multiple. But then all of a sudden the stock price surged and the multiple got up into the 60s as the growth rate increased. So let's move it a couple of more years. Now what we see happen is we had this surge in growth, which created a surge in stock price. Earnings determine market price. But then again, we had a 25% drop in earnings from 444 to 334 from fiscal year 22 to 23. And that made the stock vulnerable here, and the stock fell from its peak valuation with a multiple of 81.4 all the way down to almost in alignment with its growth rate to a 30.6 multiple. And that created another 66% drop in price. When you're dealing with a high growth stock like this, it doesn't take much of a catalyst to really change the dynamics. Now let's move this all the way out forward, and let's get to talking a little turkey here. Now, the best time once the AI became such a hot commodity to buy the stock would have been for a very short time in October of 2022, where the PE ratio got down to that 30 multiple that FastGraphs uses as a valuation reference. I want you to notice the market multiple, what we call the normal PE, was 39. That's this blue line. So anytime the stock price is above that blue line, it's trading at a higher PE than 39. The current PE is 51.8 blended PE. That's less than a 2% earnings yield. Company pays a minuscule dividend. It's not really even worth talking about. But the bottom line is, even if you're using the 39 multiple, the stock looks overvalued today. But here's what I want you to understand. When a stock is growing as fast as this, you really can't overpay for the stock and lose money. This would indicate a 12.46% rate of return if the stock earned this money that the analysts are expecting, and we'll look at that here in a second, and if it traded at a 30 multiple, which is the orange line. So let's dig a little deeper into that and get a little more granular with that and go into the forecasting route. Now, first of all, there are 45 analysts that are forecasting 2024's number. There were 35 that forecast 2023's number that came in at 334. I want you to notice the analysts 6 months prior to that were at 537. Then they dropped it to 340. Then they dropped it to 327. And then the company actually earned 334. So one thing you need to remember about forecasts, they're within reason, hopefully, but they're very rarely going to be perfect. Now, for 2024, we started out with 446, which was significantly above the 327 or the 334 that the company earned. But then 3 months ago, analysts raised it to 769. And as the AI really began to unfold and become mainstream, analysts raised it to 1077. And the current estimate is for 1076. And this is a true consensus. There are 45 leading analysts forecasting $10.76. I want to emphasize that. Leading financial analysts that are working on this stock and analyzing it have come up with an estimate for 222% growth over last year's earnings for this year. Those same analysts expect another 53% growth in 2025. And then a lot of the analysts drop off, but we still get a 13% growth rate for 2026. And then if you just point to these numbers here, that's that 12.46% annualized rate of return, assuming you hit all these estimates and assuming a 30 multiple. Now, if we used a growth rate multiple, a true P equals growth rate of 41.9, I can go up here to 42, which is pretty close. And now we'd be looking at an annualized rate of return. I want to emphasize annualized rate of return of 29.79. That would take $10,000 invested today and turn it into $18,429, by the end of 2026. Okay, just, 2 and a little more than a quarter of a year. All right, so that would be a pretty good rate of return. Now, but I also want to emphasize it's not 42%. Okay, you wouldn't be earning money at the rate. For you to get the 42% rate of return, the PE ratio would have to remain at 51 times earnings. Okay, that's what this number here, that would give you the 41.9 cent. That would be the full measure of the growth. Okay, but even though you don't get the full measure of the growth, at a growth rate multiple, if the PE fell to 42, you'd get 30% return. If it fell down to our cap rate of 30, you'd still get 12.5. So these are kind of, conservative case, moderate case, best case type scenarios. But I want to look at this company from another perspective now. I want to look at it from a standpoint of the normal multiple. The last 5 years, the PE has averaged 50.32. So in this case, we're drawing this blue line at a PE of 50.32. And once again, you would see that you would earn that 40%, rate of return. The PE is 51.8 right now. So you would get a very slight PE ratio contraction, which would not give you the full measure of the 41.9, but you'd still get almost the full measure of the company getting a 40% rate of return. If it maintained that, over 50 multiple, that's what this has to happen. But let me look at normal PEs for a minute. This is the 5-year normal PE. If I use this drop down, I can get longer term PEs here, and I can see that, the average PE for 17 years was 33.69. I can put that PE on the graph. So now I'm using a PE of 33.69, which would be the long-term normal. I'd still stand to make 18%. Now, if you're willing to invest in this stock and earn 18% a year, having the potential to turn $10,000 into roughly $15,000, close to $15,000 by the end of 2026, then, you could make the case that Nvidia would be an attractive stock to invest in. Now, I also want to talk about long-term growth. 7 analysts forecasting long-term growth of 35%. But that's just a trend line growth number. So I go into the custom calculator and I include the estimate data, which I've done here, into it. And then I grow that estimate data by the 35%. But now let me put that growth rate in there. I have an override here. This would be the 35% growth. This would be an average of 37.51. And going out to 3030, if it achieved all these earnings achievements, the company would generate a 26.19% annualized rate of return. Even though it's technically overvalued above the orange line, it could still be a very great investment at that point in time. Now, what that number I was looking at before that I forgot to take out of there, I went into Yahoo, and I've already shown you their estimates are very close to what you see on FastGraph from Reuters. But when I look at the next 5 years per annum, they're forecasting 74.76% growth. So I can go in here in my custom calculator and put the 74% number in here, just rounded. And this is what it would look like at 74%. So this would be a very aggressive case. In other words, you're asking a $1 trillion plus company market cap to grow at 74% a year. And, we're talking about, if you look at earnings going from 1076 to 170, you're looking at a 10 or 12-fold increase. I don't think that's going to happen. I don't think you're going to see this company become a 12 or 14 trillion dollar market cap company. I just think that's unrealistic. But having said that, I do think this company is capable of growing for the next couple of years at 40% or so, and then perhaps slowing down to something more like a 35% growth rate, which is what, the analysts are expecting from here forward. All right, so Nvidia could be still a very attractive investment. Now, as researching this stock, I want to point something else out. Okay, I just did operating earnings today for sake of brevity. All right, but I could have gone into all these other metrics. I could have looked at the company from a standpoint of cash flow. I get very similar numbers. I could have looked at this company from the standpoint of EBITDA, another form of cash flow. I get a very similar 42% growth rate. I could have even looked at this company from a standpoint of sales, and I could go through all these different time machinations like I did with the adjusted operating earnings. All right. But another thing I can do with FastGraphs, because it's helping you just research stocks deeper and faster, I can immediately go into the company's website right from our external links, and I can learn about what the company does and, what business it's in, what its expectations are. I can go into investor services on the company and look at presentations. I can look at, webinars that the company has produced. I can go into investor services, as I mentioned, and I could look at, a lot of data on the company, including the company's presentations. So I can research the stock deeper and faster and then come up with numbers that I might like. But the key is when I'm using the forecasting calculator, and the word calculator here is a key. These are calculators. They're designed to help you forecast what you could earn. You have these different PE ratios you can apply. What if it fell to a 15 PE? Then you could lose money, even if it earned this money. You could do all that work with Fast Graphs on the fly. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, running Nvidia through the paces, utilizing the Fundamentals Analyzer software tool to think with Fast Graphs. As you can see, it's a great tool. It can really help you get a good idea and do some mathematical calculations of what you might expect from investing in a company. Hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to the channel if you haven't. And for goodness sake, subscribe to Fast Graphs. What a powerful tool to help you analyze stocks better and make better long-term investment decisions. Thanks for watching. I'll talk to you guys again real soon.